In November 2013, the EITF reached final consensus on Issue 12H, Accounting for Service Concession Arrangements. My name is Erin Baylog, and I'm a Senior Manager in KPMG's Department of Professional Practice, and this podcast covers EITF Issue 12H, Accounting for Service Concession Arrangements. Service concession arrangements are contracts in which a public sector entity grants a non-government entity, the operator, the right to do business with or maintain the government entity's infrastructure assets. These infrastructure assets could be airports, roads, bridges, tunnels, prisons, hospitals, and so on. So, what is a public sector entity? A public sector entity, as defined by the final consensus, is a governmental body or a private sector entity to which the government has delegated the responsibility for maintaining the asset or providing the services related to the infrastructure asset. In a typical service concession contract, an operating entity receives the right to operate the government's infrastructure and that will be used for some sort of public service. In many of these arrangements, the operating entity may be required to make an upfront cash payment, which in some cases could be a fairly significant fee, to the public sector entity for the right to use and to operate that public sector entity's asset. The infrastructure in these arrangements may already exist, or they may be constructed by the operator as part of the contract. If the infrastructure does exist, though, the operating entity could be required to provide upgrades or maintenance as part of the arrangement. And in exchange for performing the construction, maintaining the asset, or providing whatever the service is under the contract, the operating entity might receive payments from the governmental entity. The payment structure in these contracts could vary. Payments could be made as services are being performed, as certain milestones are achieved, or as set amounts over a specified period of time. In some contracts, the operating entity may be granted the right to charge the public in exchange for the public's use of the underlying infrastructure assets. So service concession arrangements within the scope of the final consensus would be arrangements between a public sector entity and a grantor and an operating entity. They are also arrangements in which the public sector entity controls, has the ability to modify or approve the services that the operator provides, and to whom the services will be provided, as well as this price to be charged for those services. And the last scope criteria is that the public sector entity controls any residual interest in the asset at the end of the term of the arrangement. So with that, let's move on to the next slide to discuss recognition. As you may be aware, the FASB and the IASB have issued a joint leases exposure draft that defines a lease as a contract that conveys the right to control the use of an underlying asset for a period of time in exchange for consideration. In a service concession arrangement within the scope of 12H, we have an identified asset, the government's infrastructure, and the operating entity has a right to use it. But in concession arrangements under 12H, the government maintains control of all of the following: what services provided with the infrastructure. The government decides who's permitted to use the infrastructure. For example, prisons only accommodate members of the public that are incarcerated and are not otherwise used by other members of the public who aren't incarcerated. And also the grantor controls the price that the operating entity can charge for the use of the assets. And an example of this would be the government setting the cost of the toll that you'd pay when you cross a bridge or a tunnel. The government would also control any residual interest in the infrastructure at the end of the contract's term. And for all these reasons, the service concession arrangement would not meet the definition of a lease under the lease's exposure draft, since control of the asset doesn't transfer from the grantor to the operator. Before reaching final consensus, the task force discussed whether or not contracts that are for the whole life of the asset should be within the scope of the service concession arrangement's final consensus. This would be consistent with IFRS accounting for service concession arrangements under IFRIC 12, which does include arrangements whose term covers the entire economic life of the public service entity's asset. After some discussion, though, the FASB concluded that inclusion of arrangements for the entire economic life of the asset might challenge the conclusion that the concession arrangement does not meet the definition of a lease, which is the core conclusion for the issue. As a result, there will be a U.S. GAAP to IFRS difference related to scope, and the other more significant difference between U.S. GAAP and IFRS is that IFRIC 12 describes how to account for service concession arrangements, whereas issue 12H will send us to other GAAP codification topics or subtopics for accounting for service concession arrangements. All right, let's take a look at the next slide, and we'll go through an example of a service concession arrangement, and we'll continue our discussion on recognition as well. Our example facts include that we have a state, which represents the government grantor, that has a need for a new highway. It contracts with an operating entity to construct a road for public use, under which the operating entity agrees to the following conditions. Construction of the road and a toll station must occur within a year. The operator would operate and maintain the toll station in good working condition and resurface the roadway as prescribed by the government. And in exchange, the operator would receive the right to collect for its own benefit charges from the public. In this case would be motorists using the toll road. Pricing is established in the agreement by the government entity, and the operator must seek approval from the state in order to change the amount of the toll being charged. So first things first, we'd evaluate whether or not this arrangement would be within the scope of the final consensus on issue 12H. And if we take a look at the three criteria, we have an arrangement between a government entity and a private operating entity. So we have the state as grantor, so we meet that one. The grantor controls the services provided with the asset, to whom and at what price. So we can see in our facts we have the state controls the construction and the operation of the toll road, and the operator can charge motorists, but the government controls what that toll price is. The grantor controls the residual interest. Let's see, we have the state who receives the road back at the end of the 5-year term of the agreement. So I think it's safe to conclude that the arrangement is within the scope. And to recap the previous slide, under the final consensus, this arrangement would not be accounted for as a lease since it meets the scope criteria for 12H. The final consensus also states that the operating entity should not record property, plant, and equipment with respect to the highway and the toll structure, even though it constructed the assets and will be periodically renovating them. But the final consensus did not expand the scope to address how to account for service concession arrangements, and instead the consensus directs us to other codification topics or subtopics. Depending on the terms of the arrangement using other GAAP, some operating entities might record a financial asset, an intangible asset, or possibly both. So moving to the next slide, the final consensus proposes a modified retrospective application to all existing contracts at the beginning of the year, and this will be recorded through a cumulative effect adjustment. The proposed effective date is for interim and annual reporting periods beginning after December 15th, 2014 for public entities, and for annual periods beginning after December 15th, 2014 for non-public entities. Early adoption will be permitted, and the next step is for the FASB to consider the proposed standard for endorsement. Okay, well, that about wraps up our podcast on the final consensus, which was reached on issue 12H, accounting for service concession arrangements. You can find more information on this topic as well as many others on the Financial Reporting Network page, which is accessible at www.kpmginstitutes.com. I want to thank you for listening, and I hope you have a wonderful day.